Lululemon, the premium athletic apparel brand, is currently trading around $159 a share with a price-to-earnings ratio of just 11.1. This line chart tracks historical PE averages over the last decade. The company's average multiple sat near 42. That means its valuation multiple has compressed by a staggering 74%. On Wall Street, an 11x multiple is a death sentence. It's a valuation typically reserved for deteriorating brick-and-mortar stores slowly going out of business. The market has collectively decided that this premium athletic brand is a doomed value trap. But the underlying financial data contradicts that fear. The business generates elite metrics, including 59% gross margins and a 45% return on capital. This measures how efficiently a company turns the cash it deploys into actual profits. Looking at this balance sheet trend chart, notice the massive blue asset bars against a flat purple debt line. The company holds $1.8 billion in cash, zero long-term debt, and nearly $8 billion in total assets. It is effectively unbankruptable. This earnings snapshot chart proves the core business is still expanding. The bottom bars show year-over-year growth, with quarterly revenue hitting $2.57 billion and net income reaching $351.9 million. Why is Wall Street pricing a high-margin, debt-free, cash-generating machine like a dying mall brand? The market's fear is grounded in real headwinds. The North American market is highly saturated, and Lululemon is losing ground to aggressive competitors like Vori and Alo Yoga. We can see the specific trigger for this panic in the same earnings snapshot chart. Free cash flow dropped from $122.2 million to $82.4 million, a 3.7% decline for the year that signals rising capital intensity to nervous investors. To accurately diagnose what is happening, we can apply a categorization framework developed by legendary investor Peter Lynch. Under Lynch's system, Lululemon is not dying. It is simply graduating from a hyper-growth fast grower into a mature, highly profitable stalwart. This graduation creates a growth gap. Companies are punished here because growth purists sell their shares before value investors step in to buy. The massive stock drop reflects a painful, temporary shift in investor demographics, not a permanent impairment of the business. This brings us to intrinsic value, separating the price you pay for a stock from the actual cash the business can generate over its lifetime. This valuation bridge chart visualizes the extreme disconnect. Even conservative models place Lululemon's true intrinsic value squarely between $471 and a $621 target. This gap is supported by an untouched runway. The company operates a highly lucrative growth engine in China, expanding at 46%. Domestically, its direct-to-consumer moat, selling entirely through its own stores and website, successfully defends its premium pricing power despite the influx of new competitors. Even if the company's growth permanently slows, the math dictates the stock is currently trading at a massive discount to its worst-case scenario. You have the opportunity to acquire a world-class, highly profitable company at a historically depressed price. The combination of a fortress balance sheet and an 11x PE ratio creates a massive margin of safety against further downside risk. Because of this heavy downside protection, the official deep value intelligence verdict for Lululemon is advocate. The proper strategy is incremental accumulation. Build your position over time, monitoring the quarterly data to ensure free cash flow stabilizes and gross margins hold above 55%. To access more advanced research, applications, and our intelligent multi-agent platform, subscribe today at deepvalues.ai. To track the market temperature, download the Buffett Indicator iOS app from the Apple App Store. All analysis is based on public sources, is generated by an autonomous AI system, and is provided solely for educational purposes. It does not constitute financial, legal, or investment advice. Subscribe to our sister channel at Deep Values for broader insights into life and investing philosophy, and drop a like on this video to support the research.